how much money do you really need to buy a home? Spoiler alert, it's actually not 20% down.
What?
In fact, according to the National Association of Realtors in 2023, you'll actually see in the statistic here that first-time homebuyers had a median down payment of 8%. Then what you'll actually see is repeat buyers or people who are upgrading put about 19% down. So what I can see here is actually first-time homebuyers will utilize a low down payment option. Then when they upgrade in the future, they'll use their equity, or what I call their house wallet, to upgrade and put a larger down payment. So you might be wondering, what's the right down payment option for you? By the way, I'm Nathan. I've earned 120 plus 5-star reviews by helping homebuyers bust through home buying myths, plus bought and renovated over 15 units just like this one here. So I'm gonna walk you through how much money do we need to buy a home that fits your goals so we can go from guessing to planning. So this is what I'm gonna cover today. Number 1 is your minimum down payment options. Number 2 is your Lurn purchase quadrant filter, which you can see like right over here. And then number 3 is estimated closing costs, because there's multiple rules of thumbs out there. And then number 4, which is my favorite section, is your payment ratios. So basically, if you stick around to the end, I'm gonna cover how to calculate your monthly payment based on multiple down payment options and multiple purchase price options. So if you're anything like me, you wanna figure out how much do I wanna put down so that I can have a comfortable payment. So that's what we're gonna cover in that section. So without further ado, let's jump into the video. So here we're gonna talk about the minimum down payment. So think of this as like the bar that you need to hit and be above. If you watch my other content, you know that I talk about the lending trifecta. So I use the lending trifecta to identify the constraints of someone's scenario. It uses the theory of constraint. So basically focus all of our attention on each of these sections. So income, money in, credit, money out, assets, money saved, and then we focus all our attention. So if we've identified in the lending trifecta that assets or money saved is the constraint, this section is gonna be super helpful. So if you actually have more money saved than the minimum down payments, meaning the assets isn't a constraint, you definitely want to stick to the very end where I cover the monthly payment ratios in chapter 4. So that's where I'm going to show you if you have 5, 10, 15, 20, or even more percent down, you can kind of give a rough idea what your payment's going to be. So why don't we start with the lowest down payment option first, which is going to be your VA option. So you might notice in this column here, FTHB, just a quick acronym for first time home buyer. So there is actually no first time home buyer requirement to use this option. And you might be wondering the down payment. This option, 0% down. On the screen, because I couldn't fit on this board, you'll actually see shortcuts that I applied based on each of these loan programs. So this one's basically active duty or veterans. So that way you can quickly identify if this would be a good option for you. Next is gonna be USDA. Do you have a first-time homebuyer requirement? No. And then what's the minimum down payment? 0% down as well. And the shortcut, if you want to think about what USDA is for, is basically rural areas. So basically like not downtown living. And there is a website out there. So if you actually Google USDA eligibility map, you'll be able to find the areas or the houses that are eligible for USDA. Next is going to be conventional. And is there a first-time homebuyer requirement? In this situation, yes. In order to put 3% down, okay? So basically, if you're buying a $100,000 house, that's $3,000. If you buy 500, just multiply 3,000 by 5, so that's $15,000. Then next is gonna be FHA. Is there a first-time homebuyer requirement? Most people think that there is, but there is no first-time homebuyer requirement for FHA specifically. Some situations you might be able to have 2 FHA loans, but talk to a mortgage advisor. Same with VA. You might be able to have 2 VA loans at the same time. It's called bonus entitlement. So this is actually 3.5% down. So if you're buying a $100,000 house, that's $3,500. If you're buying a $500,000 house, just multiply 3,500 by 5. Next is gonna be your conventional, okay? You're like, whoa, there's 2 of them. Yes, this one actually does not have a first-time homebuyer requirement between these 2. That's the only difference there. This one, you do need a little more money down. So that's 5% down in that situation, okay? So regarding shortcuts, because I totally breezed over this, for conventional, it is gonna be what's called first-time home buyers and risk-based pricing. So the way I like to think about risk-based pricing is if you have really good credit, a lot of money down, whatever, better pricing, right? FHA is kind of what I call flat rate pricing. So basically, if I have a credit score 660 versus 760, generally speaking, your interest rate is going to be very similar, whereas this is going to be impacted quite a bit. So risk-based pricing for conventional, FHA, I call it flat rate pricing. That's just my nomenclature. And then conventional 5% down. This is also risk-based pricing. Now, if you've done a little research, there are down payment assistance and grants out there for first-time home buyers. There are some that are, you don't need to be a first-time home buyer, by the way. Generally, that's gonna be a range from 1 to even 5% down. And the reason why I'm not putting it on the board here is there's so many pros and cons, it's very hard to actually condense it all into one video. So I always recommend talk to a mortgage advisor to see if it actually makes sense. If you have your own money, generally it's gonna be better to just get a regular loan here. But if you don't have the funds, then down payment assistance and grants are gonna make sense. So you might be wondering, I know I covered some of these numbers with how much to bring down, etc. So what I'm gonna show over here is actually adding another column on the table that you can see on the screen of if you have a $100,000 example. And the reason why I'm doing $100,000 for a home, I know if you're watching this in Southern California, that's where I live, obviously there isn't a $100,000 home out there, but we can use this as an easy multiplier, I should say. So I'm actually gonna name it per 100,000. And the reason why I say this is if you have a $500,000 house, right? Let's just take conventional 3% down, which is 3 grand per 100K. If you're buying 500, you just multiply 3,000 by 5, which is 15,000. Then you can do the same exercise for 3,500 or even the $5,000 option. So again, you can customize this or even screenshot this and just save this just in general. And you can do the math on your phone. Do I have enough money saved up for the minimum down payment? So now that we talked about the minimum down payment required, let's move on to chapter 2, which is the purchase quadrant filter. I know I wrote down purchase analysis there, excuse the typo. But the purchase quadrant filter is a document that I send to all our clients that go through the process, and you can actually use it yourself too. And you'll be able to screenshot it as well. And basically the way I like to think about it is a way to reduce the noise. So that way you can see multiple options and filter out which one's gonna be the best for you based on like short-term items and even long-term items. The way I fundamentally think about it, it's almost like going from 1080p to 8K quality. Okay, so let's jump right into it. So what you can see is the first half or the left-hand side of the quadrant, which you can see on my screen here, is gonna be what's my monthly payment? Number 2, which is what's my out-of-pocket? You'll notice number 1 and 2 are labeled as now. The reason why is this is more weighted to helping or hurting you now, right? Or impacting you now. Now, it doesn't mean it doesn't impact you in the future, right? Obviously, if you have a very high monthly payment, it'll impact your savings, which will impact your retirement in the future. But this is more weighted, I should say, in the now section, okay? Number 3, which is what are the pros and cons for each options? Number 4, what does my investment look like 5 to 10 years from now? And then you'll notice 3 and 4 are impact for later, essentially, right? Very similar concept to the now. It's not like it doesn't impact you now, it's just more weighted for later. Or at least that's the way I like to break it down, right? Now, again, you can remove the now and later labels if you wanted to, but at least if you have these 4 items, it'll allow you to, again, filter out those options and figure out what's gonna be the best fit, okay? So let me walk you through an example of down payment assistance versus conventional 3% down. Let's just assume this hypothetical home buyer is a first-time home buyer as well, so they can utilize the 3% down. So again, this is just an example to walk you through how to use the filter. Your specific scenario will be completely different. So again, just think about using this as a how to use it, and then that way, when you actually get your mortgage options, you can run through this filter and apply it yourself. So number 1, what's my monthly payment? So let's compare down payment assistance, which is options 1. And let's just say hypothetically the payment is $3,500 a month. Now I get it, if you're watching this and you're comfortable with $2,000, $1,500, whatever the number is, This is just a training on how to use the purchase quadrant filter so you can apply it to your scenario. So again, this is just an example, $3,500 a month is this situation. Options 2, if you were to bring your own funds, conventional 3% down as an example, is $3,400. So it's slightly lower than options 1. Now I do normally see this where down payment assistance is gonna be slightly higher. The reason for that is you're gonna have a limited amount of pool of lenders that can actually do it, whereas conventional 3% down, you're gonna have more options, more competition, right? So just think about it that way. Now there are some exceptions, right? Now if you're watching this video, you bought a house with down payment assistance and you're like, wait, but my payment was definitely lower than my other options. That's totally cool. Usually there are exceptions out there. So that's why it's actually really important to know all the pros and cons and the ins and outs of down payment assistance and grants, okay? Number 2, what's my out of pocket? So the really cool thing with down payment assistance and grants is generally you can get your full minimum down payment covered, like I mentioned in an earlier section. So in this situation, this home buyer just has to bring in their closing costs, okay? Which we'll cover in the next section. And sometimes you can get that covered by the sellers as well. So options 2, which is conventional 3% down, right? You are gonna have to bring in your out-of-pocket down payment plus closing costs, okay? So number 3, what are the pros and cons? So options 1, definitely big pro, lowest out-of-pocket, and you might be able to buy a house where you feel like home ownership is out of reach, right? So in my opinion, this is a great way. If saving up for a down payment will take too long, where the home prices will just skyrocket and never be within reach, fantastic option. So one of the cons is gonna have a slightly higher payment in this specific scenario. Remember, I mentioned there are exceptions. And what is gonna happen is generally those lenders are gonna close a little slower. So you may be at that 30 plus closing mark, whereas some lenders will be able to close faster if you do like a regular type loan. So it may be less competitive, but if the house you're buying doesn't need to be competitive, then that solves that problem, right? So if you're going the route with down payment assistance and grants, this is where you want to ask your mortgage advisor. You really want to understand what are the pros and cons of that option, because usually if you're given something like as a gift, grant, down payment assistance, or something of that nature, there are going to be some terms and conditions that you want to be super mindful of. Okay, moving on to options 2, which is your conventional 3% down, right? What are the pros? Lower monthly payment, faster closing. You may be able to work with a lender or a bank that can close within like 14 or even 21 days, which is much faster than 30, right? May make your offer more competitive because generally if someone's selling a house, they probably need the money for a reason. And then one of the cons, moving the con section, is higher out of pocket, right? You are gonna have to bring in your down payment. You're gonna have to bring in your closing costs. So that's where you wanna evaluate. If you have in the lending trifecta that I mentioned earlier, the money in, money out, money saved, right? If you have the money saved, then this may not be a con. And this is why I actually really like the purchase quadrant filter and specifically the section 3, which is pros and cons, right? If you lay it out, the pros and the cons, and you have a con, then you want to really figure out how can I actually resolve this con, right? So for example, right, if I have my own money, then the con for the conventional 3% down really isn't a con. Or, hey, I'm never going to refinance or sell this house, then really the down payment assistance and grant isn't going to be a con, right? So that's why laying it out in this purchase quadrant filter, which you can see here or on the screen, that's why the purchase quadrant filter, like I said, it reduces the noise so that way you can see from 1080p to 8K quality. So number 4, what does my investment look like 5 to 10 years from now? And the reason why I like this is because if you're gonna be buying a house, you wanna make sure it's a sound financial investment, right? So you wanna make sure you net out positive 5 to 10 years from now. So I actually use this tool to kind of project your equity 5 to 10 years from now based on the mortgage options. So remember, equity is gonna be your house wallet. So that's just simple language that I like to use. So instead of using your cash wallet, you can use your house wallet, right? Now this does change based on the market you're in, and you may have higher appreciation rates, which is your home price going up over time compared to other areas, right? So Southern California historically is a little faster than most areas, okay? So that's where you want to consult with a real estate agent and really figure out what's the appreciation rate that I'm working with if you wanted to calculate this on your own. Now you can write down how much would you net out 5 to 10 years from now with your equity or your house wallet. So again, going back to why I use the purchase quadrant filter, if you're anything like me, having all these options rattling around your head causes analysis paralysis. So really just by putting it down on paper, then you at least get it out of your head and onto paper so you can clearly see it. Now that we're on chapter 3, let's talk about closing cost. And you might actually see on the board of knowledge here, FTC, which means funds to close. So this will actually help you on the purchase quadrant right over here, which is what's my out of pocket. And you can label that FTC or funds to close. What goes into funds to close? Very simple math equation here. Down payment plus closing costs. So now that we're going to go over this section, you'll be able to combine and fill out that funds to close or what's my out of pocket section. So here's the really crazy thing with real estate and mortgage education. There's so much data out there that sometimes it could be confusing as a first-time home buyer. So that's why I actually make these videos. So you might be researching what's the closing cost range or what's my closing cost going to be. And you'll see like tons of different ranges, 1 to 3%, 2 to 6, 2 to 5, 3 to 6, 1 to 7, something crazy like that, right? And it's very confusing, right? Because what I find is you're missing the context of how they get that information, right? So that's what I'm going to attempt to do in this section here and give you better rules of thumbs based on your scenario so that way you can apply it if you're buying like a $100,000 house, $1 million, whatever it is. Let me give you some context, like I promised, of what goes into closing costs and why there's actually a huge range that you might see online. Some might be from people who work in the East Coast versus the West Coast, right? So when it comes to closing costs, there definitely are many factors. So number one is time of month you're closing. That's a big one. Number two, what's your property taxes and your homeowner's insurance? That's also a major factor because if you're looking in Florida versus California, your homeowner's insurance is actually going to be majorly different. So number three, are you going to include taxes and insurance with your mortgage? Number four, what interest rate are you choosing? Number five, what purchase price are you buying at too? So those are the main variables that actually input into your closing costs, all right? So I'm gonna jump to the board of knowledge and I'm gonna start with a range of a $100,000 house to $1 million. So you can see my beautiful house here. Let's just say it's $100,000. And then you have a range. Let's do $1 million in this situation. Now, this is where you're gonna see online, it's like 2 to 5% or something like that. So I am gonna give you a range as well, 2 to 5% of the purchase price, okay? But we wanna do not 2 to 5%, we wanna actually swap it around, okay? So here is, I would estimate closing costs to be a little closer to 5% and then swap it, right? Where if you're buying close to $1 million, you're gonna be a little closer to 2% of your closing costs, okay? So instead of 2 to 5, and I find it really misleading online, right? When you see a range of 2 to 5%, because you think it's 2% of 100K, but really it's actually gonna be swapped. The lower your purchase price, and I'm gonna explain this in a second, the lower your purchase price, the higher the percentage you wanna use. So I'm gonna use a crazy example, okay? So let's say you're buying like a $10,000 house. I know it sounds crazy, right? And you have an appraisal being done and an inspection. So appraisal and inspection are usually like 500 bucks a pop. So even though your house is just $10,000, your appraisal is pretty much gonna be $500 and your inspection is still gonna be $500. So like, even if you're buying like a $2 million property, your appraisal, now that's probably a bad example, but your appraisal is probably like 700 to 900, so it's a little bit more, and your inspection is probably gonna be similar. But you'll notice that a $10,000 house has very similar fixed costs, okay? So that's why the percentage, if you see right here, is gonna be a lot more the lower you are in purchase price. And then if you're buying higher in purchase price, your closing cost percentage is gonna be a little lower. So if you're over here and you're buying $1 million house, I would estimate right around $20,000 for closing costs. But if you're on the lower end, you're buying a $100,000 house, you are gonna be looking right around $5,000. So I went back to our past closings and looked at 500K as well. And it was on average right around 3.5% of closing cost, Now again, this is average. That means some were lower, some were higher. So again, based on the timing, all those factors and variables that affect your closing costs. So this will be kind of a good rule of thumb if you're looking at right around 500K. If you're between there, kind of do the difference between those two, okay? And also, it doesn't hurt to overestimate closing costs too, because again, if you have more money saved up in the bank, probably not a bad thing. So if you're right here and you just want to round it up to 4%, more than likely you'll be well below 4% of the purchase price for sure. Also, just in case if anyone's watching this and you're buying in that 1 to 3 million Southern California clients as well as the Bay Area. So if you're buying in that 1 to 3 million range, usually I recommend 2% of the purchase price here. And then as you go up, let's call it 2 million. I would estimate this to be about 1.5% of your purchase price, and then about 1% of the purchase price when you're getting up to that range. And this is for purchasing. So when you're selling, completely different ranges and stuff like that. So again, this is estimated closing costs when you purchase. And quick rule of thumb, reminder, funds to close, which is basically what's my out of pocket, is down payment plus closing costs. Before we move on to the next section, just a quick pro tip. The closing cost percentages, I would recommend multiplying that by the purchase price, not the loan amount, but the purchase price. So that'll give you a more accurate figure. So for example, $100,000 house by 5% is $5,000 based on the purchase price. Now that we're on the fourth section, payment ratios, this is my favorite section. It took a lot of time to actually crunch the numbers and do the math, so I hope it saves you some time. So as promised, the goal of this section is to show you what your rough monthly payment's gonna be. And all you need to figure out is your purchase price and taxes and insurance. And fortunately for taxes and insurance, you can figure that out like online. And then purchase price is just monitoring the market and looking at purchase prices, right? So I think this will help a wide range of people, but I am gonna walk you through how to use this. I know it's a little technical, but I promise once you understand like what you're looking at, it'll be really easy. So in this study, what I ended up doing before I show all the numbers is I did an average of a 680 to 740 credit scores, basically what your interest rate's gonna be with that wide range. And then also I averaged the private mortgage insurance rates from 680 to 740 as well, and across 20 other lenders, okay? So something that you may not know is some lenders will actually have different mortgage insurance rates compared to others. So just a little quick pro tip there. So what I'm gonna show you is when average rates hit 6, 5, and 4%. So again, if you're watching this video and rates are at 6.5 or even above that, then we can kind of do a deduction of how much it would be by adding an extra 0.5%. But if you're at 5.5%, you can just do the math of the difference between the two. So the key word though is average. So you might be wondering, how do I figure out my average interest rate, right? So the way I actually base the math on this is using this website here, which you can see, and you can save it as well if you wanted to. And I actually would highly recommend you just save it and just bookmark it. So this is the average mortgage rates according to Freddie Mac, and this is where I base the rates on, right? So when rates hit 6%, generally speaking, your FHA and VA loans, so that's your government loans, are gonna be 0.5% lower than this average that you see here. So let's say, for example, your average rate right now for conventional is 6%, just as an example. FHA and VA are generally gonna be around 5.5%. So that's just what I've normally seen in pattern-wise, okay? And then the other thing is based on the average mortgage rate that you see on the Freddie Mac website is it's usually based on high credit score, high down payment, right? So again, that's why I had to do an average of lower credit scores and do all that math for you guys. Okay, so without further ado, let's jump into it. And you'll see we're gonna start with 6% first, and I'm also gonna do the math with you, okay? So what you see here is your monthly payment ratio. So let's start with the low down payment section, and I'll show you exactly how to use this. So what we're gonna do is take a $500,000 example, and I'm gonna do the math with you guys on my phone here. And like I said, $500,000. And what we're gonna do is type that on our phone, so 500,000. And what we're gonna do is take this low down payment, let's just do 3% down. Average payment ratio is 0.728%. So how you wanna type it on your phone is you just wanna do the 0.00, so 2 zeros, then 728, multiply that, and you'll get 3,640. How cool is that? So this will be your principal and interest payment if you wanted to do a 3% down option at 500,000. So the really good thing is you can change this based on a $600,000 purchase price, $200,000 purchase price, whatever it is. So all you really need to solve for now is just how much your homeowner's insurance is gonna be. Now you might be wondering, how do I figure out that? So you can do quick rules of thumbs on Google, or just reach out to your insurance agent, whether that you have renter's insurance or your insurance broker, and ask them, hey, I plan on buying in this area. What's the average homeowner's insurance for this type of house? Type of house meaning condo, townhome, or single family, okay? They should be able to give you an average. Then you can add your homeowner's insurance on there. So what I'm gonna do is take that 3,640. So for California specifically, for a single family house, conservatively, without being in a fire zone, is gonna be about $200 or less. If you're buying in an HOA, it's gonna be way less than that for sure. So now we're at 3,840, okay? So the other thing that you wanna do is figure out how much your property taxes are gonna be. So for California specifically, the rule of thumb is just take the purchase price, multiply it by 1.25%, okay? So I'll show you how to do the math here. So what you wanna do is take your purchase price, so 500,000, times 1.25%, okay? So now you just do the 0.0, so it's 1 0 this time, 125 is 6,250, that's your annual. Then you divide it by 12, then that's $520. Now, what you wanna do is add that to the payment that you saw earlier, right? Which is about 3,840. And that's gonna be your monthly payment, 4,360, based on this hypothetical example. So that's for California specifically. But if you're in a different state like Texas or other states like Florida, you can actually ask your lender or ask your real estate agent on estimated property taxes. Or what you can do is look on Zillow, Redfin, and you can actually pull the property tax rate that the seller had, or the value, excuse me. You can kind of guesstimate from there. The best way to actually do it is pull the property tax certificate from the county website, and you'll be able to find the tax rates from there. That's a lot of work, in my opinion. Probably easier just to ask your mortgage advisor to get that information, or you can kind of Google average property tax rate in my area. So remember from that example earlier, the principal and interest payment was about 3,600, and then the with property taxes, insurance, and the whole shebang was about 4,300, right? Now, what if you wanted your payment to be about $100 less a month, right? We can actually do that same exercise. So what that looks like is we can take $500,000. So I'm gonna do the math with y'all on the phone here. $500,000. Then let's look at a medium down payment. So what you can see here is 5% down. Average payment ratio is 0.698%. So we can take $500,000 times, do that 0.00, remember 2 zeros, 698. And then the payment is 3,490. Then you add your taxes and insurance from there, right? But if you remember, the principal and interest from earlier was about 3,600. So this is gonna be well below an extra $100, right? So that's the really cool thing, is you can actually use this and customize it based on what you're comfortable with. The goal is, remember, figure out what your comfortable payment's gonna be, right? Whether that's 1,000, 2,000, 3,000, whatever it is. And you can use this table and figure out what's gonna be the best for you, whether you're VA, FHA, conventional, etc. Now you might be wondering, what's the best loan program for myself? So I actually got a lot of DMs on Instagram about how to figure out what the best mortgage option is gonna be. So feel free to subscribe when that video actually launches. You'll be the first one to know. Okay, so at the time of recording this is the end of 2024. Might be posting this in 2025, but hopefully in the future, rates continue to move down and the average rate hits 5%. So what you're gonna see here on the screen is your monthly payment ratio in a different format for 5% average mortgage rates, right? So feel free to screenshot this and refer back to this whenever this does happen. Or if you're trying to calculate, okay, so here's my payment right now when rates are at 6%. If I refinance in the future and it hits 5%, the average again, this is what the rough payment's gonna be. So again, these are just rough ideas, but it'll get you really close, okay? So feel free to screenshot that. And then if average rates hit 4%, which would be great. I don't know how long that's gonna take, but fingers crossed, hopefully in the future. Same exact thing, you can screenshot this table, save it for later. And remember, pro tip, go to the Freddie Mac website, and that's completely free to use. That's whenever the average rate hits that, okay? So whenever this number on the screen on Freddie Mac hits 5%, 6%, 4%, whatever it is, then you can use this table. So $1 million question, you might be wondering, what if the average mortgage rates that I'm watching this in the future is 5.5%? So great question. So the way that I would do it, it's gonna take a little extra math, but I promise it'll be worth it, is you'll do the 6% and the 5% math. Then you're gonna take the difference between the two, right? So that'll get you really close if the average mortgage rate on the Freddie Mac website hits 5.5%. So I know it's a lot of math, and the really good thing is it's YouTube and it's free, so you can actually go back, rewatch it, and really crystallize the learning of how to use this monthly payment ratio, so that way you can actually use it for your future home purchase as well. With that being said, give this video a thumbs up if you like videos like this, so that way I can continue to make videos like this. And also, YouTube wants you to watch this video right over here. Feel free to give it a click. And as always, I'm rooting for you. This is Nathan, signing out.